I was going to give a kind of a background of me even before coming to the deal and how I got here and those kind of things, just so you know a little bit more about me and you'll know to what extent is my past coming even into this, coloring my perspective, so you know what to take away, what questions to ask, and that kind of stuff. So my background is I have a degree in computer science and computer engineering, a minor in economics. I moved out to Seattle in 2008. I worked for Microsoft, Amazon, so I was always in the corporate environment for them. I started off as a software engineer, ended up moving out of the engineering role into more of the product space, and to actually run the engineering teams, making the business decisions, those kind of things. But I was always in corporate. And so from 2008 to about until just this last year, but it was a couple of years ago that I started thinking what I've been doing, what I've kind of built my career doing. And, I had a stellar resume and all those kind of things. I could kind of see the writing on the wall that a lot of the jobs that were being done were going to go away. And so I was very motivated that I didn't think I was being compensated long term the way that I should have been. I was making really good money. That's not the issue. It was just that I didn't have ownership. I wasn't really in control and those kind of things. And so I kind of saw the writing on the wall that I thought that a lot of these jobs in the tech sector were going to go away and or pay a lot less going forward. And I just kind of wanted out. And I thought that there was an opportunity in some of these kind of more blue collar kind of jobs, these unsexy jobs that are a little bit undervalued, especially if they don't have huge revenues, then you're not competing necessarily with a lot of deep pocket private equity money and those kind of things. So I thought that there's the businesses that are not worth buying. There's the businesses that are worth buying, but you have to have a lot of money to do it. And then there's the in between. And so I thought that those businesses were undervalued, and the people that tend to own those kind of businesses are rapidly wanting to retire. So that was my thesis. That was like maybe 3 years ago. It was a long process to find the company. It wasn't something that like within a couple months. I think and my initial research to actually closing the deal was about 2 years. And using Acquira, I engaged probably 6 months into that. So beginning to end, probably about 18 months. Now, I found the company that I wanted to buy within 12. But it took a lot longer to close a deal. And we could talk a little bit more about that if you guys have questions about it. But closing the deal after we had already kind of in principle agreed took a lot longer than I thought it was going to. And so that's something to be aware of. But that was kind of my journey. I had a very wide thesis. I have a degree in electrical engineering, but that wasn't necessarily what I was looking for. But it's just the one that presented itself. So because I was more constrained on geography, I needed to cast as wide of a net as I possibly could in terms of what kind of businesses would I consider. And so that's what I did. If I wasn't as constrained on geography, I wasn't going to move to upstate New York or something like that, then I might have been a little bit more selective. But my main thing was I'm not going to move away. That's where my kids go to school, those kind of things. So I need to stay within a reasonable geographic range. So the business, the headquarters of the business where we are now is about 3 hours from where I am. And so I'm up there every week. Not necessarily every day, definitely not every day, but I'm up there every week and those kind of things. And I'm on the phone with everyone a lot. So that's kind of how I make it work. I think, Andy, did you send around kind of the revenue, like the kind of the basics of the company?
I only provided like the industry and the location.
Okay. Yeah. So it was an interesting company. I wasn't expecting to find something as large as the one that I ended up finding. It's a 8-figure revenue company with really healthy gross profit margins. So like it was $10 million plus. However, the owner had not been had been financially kind of sandbagging the company. He'd been taking a lot of money out of it, but making it look like it wasn't making hardly any money, some years losing money and those kind of things. But looking at the gross profit margins, I knew that that was not true. That this was a really solid company. That took a lot of vetting, and Acquire was really helpful in that. But I became convinced that like what was really going on was the owner was taking a lot of company out for personal reasons, and then that's what was hitting the tax return. And so the on paper, this company wasn't making very much, but it's actually making really good margins. I mean, it's over 30% gross profit margins, and they didn't run like a really big back office staff. So I knew that they were making good money. So those are the things that you're going to look at, is just because on paper the tax returns say in 2022 or 2023 they only made $100,000. That's not necessarily the whole story. They might have made a lot more, and especially the owner wasn't thinking about selling at the time, he might have been doing everything he could to make it look like he's not making any money at all, just to lower the tax burden. And so you're going to have to deal with that, and that takes, I mean, that takes a lot of research on your part, but then also it takes like just running it by as many experts as you can to see what actually is going on, because these books are going to be messy for these companies. I mean, my company is a little bit larger, but you know, and even still, it was kind of a mess. And so if you're buying a company that, I can only imagine, in the ones that I looked at, if you're buying a company that's, you know, in the couple $1 million revenue range, these are not financial experts. These are not using GAAP, principles for accounting or anything else like that. So like, just know that you're going to be looking at something, and there's going to be a lot of interpretation. I think I saw a question, Andy, pop up.
Yeah.
I missed it.
And ask if you did find that out before LOI.
I didn't find it out. We had an IOI, and so I got some amount of information. I suspected it, but I didn't know it for sure. And that's the thing about the LOI, is that you're not bound by it. If you find something out during LOI, then you can renegotiate, right? You're going to base it off of some assumptions that you make, you know, good faith, you know, estimate of what you're willing to pay if your assumptions are correct. But if your assumptions prove to not be correct, to the negative, then you're free to renegotiate. And actually, once you're under LOI, they're not supposed to be talking to other buyers either. And so now you're in the front row at that point, because the idea of them starting over with someone new who's probably just going to find out this information as well is not super appealing to them. So it's in their best interest and yours to work it out once you reach to that point of getting under LOI. So I didn't know it. I suspected it based on the information that I have. It was an SBA deal. That's one of the reasons why it took longer to close. And so I can tell you the structure of the deal, actually. So structure of the deal was, like I said, it was, it's over $10 million in revenue, 30% gross profit. So the closing price that we agreed on was $4.3 million. 2.7 million of that was SBA loan financed. And then the rest was either capital injection by me or a 1.5-ish, something like that, $1 million seller financing note at AFR. I think it's AFR plus 1, if I remember correctly what we did. So it's in the 4% range, something like that. It was on market, Ben. Yeah, this was through a broker. So anyway, I was competing with 4 or 5 private equity firms, like smaller private equity firms, during the deal. And so we could talk a little bit about that, about how to position yourself in that, because you are competing with people with deeper pockets, but that can be, you can use their position as PE against them a little bit with some of these guys. And so we can talk about that, but that's just the structure of the deal. So I've got a 9-year note, seller financed, and then I've got a regular SBA loan through First Internet Bank that Acquire put me in touch with. Did you do a QOE? Yes. Well, first of all, if you're going to finance it with an SBA, you definitely have to have a QOE. It's not even negotiable. Like, the bank's going to require that for sure. And a third party QOE is going to go, like, you need to hire someone to do a QOE. Um, Now, the QA is not going to tell you everything. And so, you need to get one and get it professionally done. But then it doesn't hurt to get an accountant that is an expert in small businesses, especially in the industry that you're looking at, and have them take a look at it. Even if you have to pay them, $1,000 or something like that to give them an honest, like, what questions should I be asking, that kind of stuff. These are the kind of things that, like, the more eyes that you have, the better this is going to go for you, or at least the more you can de-risk it. That's the way I would say it. It's not going to change anything, but it's going to allow you to know what landmines to avoid and how to structure the deal so you're protected if this goes wrong. If X happens, then what's in my contract? If Y happens, what's in my contract? Do I need to structure this as an earnout because I'm giving them a premium, for instance, on the last year and a half, but the year and a half before that, they were not doing these kind of numbers, and I don't know if it's sustainable. So you want to protect yourself against that. So instead of seller financing, you might want to say, well, I'm giving you this number based on last year, but last year might be an anomaly for all I know. You're telling me it's not. Okay, let's structure this as an earnout. If you're right and it's not an anomaly, then we don't have a problem. You get your money. And so, like, those are the kind of landmines. Now, if they've been doing consistent numbers for 5 years, then the earnout is not going to, they're going to be like, what are you talking about, an earnout? Like, if this fails, it's because of you. And so don't ask them for things that they're going to easily be able to dismiss, because you're just going to waste their time and they're going to get annoyed with you. So, like, make sure that you know which potential landmines that are reasonable that you can bring up. And then it seems like a good faith effort of, you have a reasonable concern, they have there's a reasonable way to do it. But if you start asking for unreasonable things, they're going to start not to trust you and think that you're just trying to pull one over on them. So, like, don't ask. That's one piece of advice. Don't ask for something that you cannot justify the request for, because if you do that, then even when you do have a reasonable request, they're just going to probably say no, or they're going to be a lot more skeptical about why you're asking. That's okay. So that's a good question. David asks, what made you choose my IOI versus the other PE firms? This is where, so one of the leadership principles, so I'm going to lean on some of my corporate speak and that kind of stuff, because that was the world that I lived in for so long. One of the leadership principles at Quest, or at Amazon, sorry, when I was there, is earning trust. And so, to earn trust, though, you have to know what the other person wants. What are they interested in? What are their concerns, worries, goals, aspirations, that kind of stuff? You're going to have to you're selling yourself in that phase. You're not coming to them, and if it's just a number, you have to understand, like, probably the people that you're buying this business from, they might have started this business. I mean, they probably did start this business decades ago, right? And this is like their baby. It's like selling the house that their kids, were born in and they brought home from the hospital. It's a numbers thing, sure, but it's not like selling stock in Microsoft or something like that. This is like their baby in some sense. And yeah, they want top dollar for it, you can imagine, in the same way that you might want top dollar for your house, but it's more than that too. Right? If you can also sell the intangible stuff of, and I'm going to bring my family and we love this house and that kind of thing, you might be able to sell someone on a slightly less, a slightly lower deal on a house if they feel good about selling it to you, because they're also worried about, they're probably members of this community. They've been working with some of these people for many, many years. They want to take care of their employees and et cetera, et cetera. So they're going to want their money. Don't think that you can skimp on that necessarily, but you are selling yourself. And basically my strategy was to go in and sell myself that this is what I wanted to do. I want this business. I'm not a private equity firm. I'm not doing this because I'm just trying to put it in my portfolio. This is what I want to do. This is what I want to carry on. This is what I want to hand down to my children. Whatever makes sense for you to sell it as something more than just a business transaction will differentiate you immediately from a private equity group, because no one believes that and they don't even sell themselves that way. So if you find a seller that actually cares about that, which I would say most do, that's going to be something that you can bring to the table, that you can say, hey, I'm not like a private equity group. Like, yeah, I want to give you what your business is worth, but like, this is going to be my job. This is going to be my life. This is like, these employees that you took care of are going to be my employees, and I want to carry that going forward. That's a really good way of selling that. Like, okay, if he's close or in the ballpark of what I was wanting, I feel better about selling to him versus that. Other thing is, read their sim carefully before you meet with them. Ask them questions and try and tease out what are those intangibles that they really care about. So, for instance, I read the sim. One of the things that they were really pitching in this company was this young kid. I call him a kid. He's like 30, but he's 10 years younger than me. So um, they were pitching him as being like the future president of this company. That they like he has the licenses, those kind of things. So like it was very important. Like they thought that this would sell their company, but it was clearly very important. Both I assumed for this kid that he's going to have a big say in whoever takes over this company, and for the owner that he feels like he's leaving this company in good hands. Right? That was my interpretation of reading that sim. Is yes, they're positioning it as you should pay me more because I've set up a really good transition plan. But then also they're telling me there's someone that I need you to take care of so that I can trust that you're taking care of everyone else. That's the way I read it. And so actually my deal was, after I went and I met with this guy, I had him drive me to the job sites and those kind of things. I asked him questions about his family. The private equity firm, that's another thing that you can do. A private equity firm is never going to ask about their family. Are you married? Do you have kids? Where do they go to school? Those kind of things. Do they play sports? Just ask them, and then you become a person, not a bank. They're not selling to a bank, they're selling to a person. This is an advantage for you over a private equity firm. So I started doing that with this guy, getting to know him a little bit more. And then actually, as part of my deal, I actually gave him a portion of the company as part of closing. That means that during the finality after the LOI, all the way up into closing, I had an ally who was incentivized to make sure this goes through. And that everything leading up until closing is going exactly the way that it should business-wise, because now I've got a guy on the inside who is incentivized. I would not have that had I not offered that. Even if it was my intention to offer that to him up front, the fact that I put it in my LOI meant a lot. Now, it's just in an LOI. Nothing's binding, right? I could have changed it later if I found out other things, etc. But I put it in there because it seemed important enough to the seller that I should make that. So David asked how much I gave him 10%. I gave it to him. I didn't now part of it was because I felt like I was with him. I felt like I was grossly underpaying for this company. Without him, I wouldn't have paid as much as I did. So in terms of, from my perspective, that was 10% well spent, and it's paid dividends. So we're going to have a record year. We're going to be up over 15 million in revenue this year. That's the most this company's ever done. And the reason is because this kid pushed it. From the time we had LOI to the purchase agreement to close, he was pushing it that whole time. And so whenever I came in, it's not like, hey, we need to figure out what we're going to do in the next 6 months or 8 months or 10 months. He has already been pedal to the metal gas because he sees numbers coming to him now. And then I also put in a clause after we closed that he could buy in for an additional amount if we hit certain performance numbers. And so he can buy at a discount. If we hit 17 million, he can buy an extra X percent, that kind of stuff. I'll get him up to 19.5 because at 20%, he has to be on the SBA loan. And so we're going to keep him right below that so that he doesn't have to become a personal guarantor on it. But this keeps him motivated, right? And so those are the kind, and that's a unique situation for my deal. But I think that the general principle applies: is find those key employees, the little intangible things. These are the people you need to make sure that you understand what their motivations are, what do they want it to look like, and everything else, and find ways to incentivize them all throughout the deal process, not just post-close and you're their boss. Do it leading up to that, because then whenever you take it, I think that you're going to find that the company will be in much better shape post-close, and you'll know way more going up into close than you would have if these guys were just going to, well, we'll see if Tripp buys it and then see what happens afterwards, right? Is he really going to reward us? Is he just saying this? Well, no, I put it in writing that I was going to reward these guys. And so like that I think went a long way because they're also not used to that. They're used to like, the owners of these businesses stringing them along. Someday maybe I'll make you owner. I'll give you an ESOP or something like that. Put it in writing. It's an LOI. It's not in contract yet. If you find something that's a deal breaker, you're not obligated to follow through if things change materially. So make your assumptions and say, here's what I would give in terms of some of these intangibles or maybe even tangible benefits, if my assumptions are correct. If they're not correct, then, just move on. And then you can renegotiate and say, well, this is what I thought was going on. I found out this. Now we need to rethink it. Totally fine and fair, and everyone will understand it so long as you're being reasonable about your assumptions and it doesn't look like you're just trying to like kind of renege on a deal with no new information. So that's kind of like the way that I structure it, and the way that I sold myself against the PE firms is I'm actually going to take the time to get to know these guys, get to know what they want, what matters to them, and those kind of things, and make it so that they're excited about the post-close transition as opposed to being worried about it. Because on day one, if now this guy who's running the construction, he was the VP of construction, now he's the president of the company. Now he's saying, okay, now I'm going to be the president. I'm going to own 10% of this company. He's excited, right? And those months leading up to it, now like he was working that whole time for him and the future of the company, not just to keep getting his paycheck in the months in between. So that's the way that I did it, and I think that you will put yourself at a really big advantage over PE firms because they're going to want to get the company for as little as possible, mainly because they don't do those kind of things. Meaning, they're going to assume some attrition. They're going to assume that they might have to hire someone to come in and do these kind of things. They don't know this business. They're assuming that some revenue is going to drop off afterwards, and so they're gonna be very conservative in their valuation typically, or put really onerous earnout clauses and those kind of things for the seller. And so if you can say, I'm not going to do that because I'm going to protect myself in these other ways, or I'm going to sell myself in these other ways, I think it's the best footing you can. Obviously, having a bigger checkbook than everyone else is always going to be helpful, but these are ways that you can help mitigate that. Are there any questions that I missed? With the seller financing, is the seller still involved? And if yes, how long? We had a 1 year in our contract. I think we had a 6 months transition plan, and with an option for me re-upping it for another 6 months after that. I honestly think that you want the old seller out as soon as possible. I don't think that you want that person staying around because then you have this awkward period. And so the more that they're only interfacing with you and doing some of those transitions and not the employees, I think the better. So honestly, it was probably the old seller for me, other than talking to me and my business partner. He didn't talk to the employees really for another except he came in maybe for a couple weeks. That's it. And so we paid him. He was still on salary for some, I think we were paying him annualized $100K a year, something like that, as part of the transition plan. But that was just to make sure that, okay, if I need him for something, I can call him. And he's incentivized to answer my calls and all those kind of things because I'm still paying him and those kind of things. But that's really it. I was just using him there as a backstop. If I had a question, I needed him to do something. I needed him to sign something for the bank that I didn't know needed to be signed, or the bonding agreement, or whatever it is. He's there. He's going to help. He's not going to be in my way. But then also he wasn't interfacing with the employees by and large for except a couple of weeks. So that was the deal. But honestly, I've used it some, but it's been kind of offline. I text him, I call him, I meet him for happy hour, those kind of things. But generally speaking, I try to keep him out of the office because I think it's just distracting for the employees. So did you ask him to contribute to the down payment? No, I didn't. He's young. He didn't have enough money to do it, but he has all the licenses that I need. He has the unlimited bonding capability. He has a lot of things that I don't have. I had the money. I didn't have some of these other things, and so I'm using him for that. But no, I didn't ask him to put any money down for that. But I knew that he wanted more equity than just the 10% that I was giving him. So I said, okay, I'm going to give you the 10%. No PE firm's going to give you that. And I'm going to allow you to buy in the future if we hit certain milestones. So then he will have skin in the game. And here's the thing: we already blew past some of the milestones, so he already paid me for some additional equity already, because we're going to have a record year. So he's motivated. He's making the calls. He's making rounds. He's really pushing it with our customers and that kind of stuff. So it works. But no, he didn't have that kind of money. If he had that kind of money, he probably would just bought the business himself. And so like he's more conservative. He's younger. He didn't have that kind of network. Didn't feel comfortable doing it, which it was to my benefit. I could take a little bit more risk than he can. And so it was kind of a win-win in that. But if he could have put down, $100,000 or $200,000 or something like that to help buy the company or buy his portion of it, like he should have just bought the company, right? He should have just gone and get his own SBA loan and then just worked it out. He could have. He probably could have gotten a better price than I could have too had he done that because they needed him. So yeah, it didn't feel right or smart to me to ask him to put money down. Do you think giving the seller consulting agreement instead per hour would have been better than an annual salary? Maybe. I guess one question that I would have for your bank is whether or not what are they going to want? Because a lot of times these seller financing or sorry, a lot of times these SBA loans, like the underwriter or whoever, and it might not even be an actual SBA requirement. It's just what they want to see, especially if you're moving into an industry that you've never run a business in and those kind of things. They might want that person to be on salary or something like that as opposed to a consultant. Because he could always decline the work, whereas if he's on salary, then he's kind of obligated to do the job that you're paying him to do, or it seems safer maybe for an underwriter's perspective. So I would ask your bank about that, honestly. Like you could do it that way, but the bank may or may not want it. I've found some really strange things with the bank in terms of that, in terms of what they're going to require and the exact wording that they're going to want with some of these kind of post-close operating stuff. So I would ask your bank about that. Okay, did I miss anything else? Okay, so we're about halfway through. So let's talk about, I kind of alluded to it kind of post-close. A lot of your employees are going to be a little bit antsy. They're going to want to know, in some ways, they're going to want to know that you're willing to change things and willing to listen to them, but then also that you're not going to come in and change everything immediately. So you need to be able to walk that balance. So meeting with them, grabbing lunch with them, ideally before close. Like once you kind of have the LOI and the agreement and that kind of stuff, there's really no reason for the seller to say, no, you can't meet with any of my, you can't like have the cell phone number of this key employee or something like that. Like take them out to lunch and just get to know them. And ask them about their family, that kind of stuff. That builds trust. And then also, ask them candidly, even before you're there, like, what would you change? What's going well? What's going, poorly? Those kind of things. Like, take their feedback, write it down, think about it, those kind of things. Even run some ideas by them about maybe how we could fix it and those kind of things. Like, do that. Because you don't even own the company yet, right? Now it's you like you're setting the tone that you're coming in to learn. You're not coming in to be a dictator and just like change the way they've been doing everything and act like you know everything, and you're not going to take their feedback because after all you're the new owner and those kind of things. That's not a good idea. Now some things you probably do know that they don't, and so depending on your past experience, you might have experience in how you do things in, say, corporate America or something like that actually small businesses or medium-sized businesses should do too, but they don't. And so you are going to have things that we need to do this, we need to do that, and we need to do it this way, and that's going to be true. And you're going to bring that to the table. So don't be shy about that, but don't come in day one and just be like, we're changing all of this, those kind of things. And then the other thing that I think is useful, and this is another Amazon thing, is, just kind of, what I did was I sat down, and when I was talking to everyone about it, I was like, okay, here's the thing that I want more than anything. I want us to fail fast, and that gets everyone's attention. And what I mean by fail fast is that if we're going to try something, I want to know whether or not it's working. And specifically, I want to know that it's not working as soon as possible. Meaning, if I come in and I change something, I'm going to have some metric by which I'm going to judge whether or not that thing that I tried, how long am I going to give it? How am I going to judge whether or not it's success or failure? And be willing to say I was wrong and move backwards. And you have to follow through on that, and you have to explain that. But that's one of the cultural things that I think could be helpful, because a lot of times these guys are like, hey, we do it the way he told us to do it and that kind of stuff. And so this idea of failing fast, not really part of their culture, is I want you to try things, but if you try it, I want that to be the ethos. Here's how long I'm going to give it. Here's how I'm going to judge whether or not it's working. Here's the things that could go right, wrong, etc. And then we just have an honest conversation. Is this working or is it not? So, for instance, we use this construction kind of management software. It's called Computer Ease. Very popular in electrical contracting. It's a way of helping manage project costs, keeping things straight, those kind of things. Now, you have that for the job costing and construction side, for invoicing, all that kind of thing. And then you have QuickBooks. Right. So we have these two different systems. And so you would think these are kind of related, right? Like all of this information that we're putting into Computer Ease, we're just going to have to put that again into QuickBooks. We're double entering it. They're used for slightly different purposes, but it's the same information, right? And so, I did some research on that, and it turns out that Computer Ease had actually a finance module that this company had never used. That was meant to be kind of a replacement for QuickBooks. And I was like, well, QuickBooks can't do what Computer Ease can. Computer Ease is saying that they can do what QuickBooks can. So why don't we eliminate one of these so we don't have all this double entering these costs and everything else like that? And I was like, so I think that this is going to simplify things. That's my hypothesis. I want to implement it. We're going to give it 30 days, and we're going to see, make sure that it's working. We're going to do it in both places. So we're going to put it in Computer Ease still, and we're going to use their module, and then we're going to keep putting it in QuickBooks so that I can see whether or not it's working, right? Because these should be the same, right? Like our P&L, our balance sheet, all this kind of stuff should be the same. They should not change between Computer Ease and QuickBooks. Well, it turns out that this was completely wrong, and Computer Ease is not good accounting software and cannot do all the things that we thought it could do, and they said that it could do, but it doesn't do it, or you could do it, but it was so convoluted and difficult to use that it was actually easier to just double enter. And so basically I said I gave this 30 days, and then we sat everything down and we're like, listen, this is an instance of fail fast. This was my idea. I thought this was going to work. It doesn't work. I've collected all your feedback. These are the problems that we're seeing. We're going to go back to the way things are. I'm going to call Computer Ease. We're going to get rid of this module. We're just going to keep doing QuickBooks, right? And so you have to admit, we failed at this, but at least now we know, right? And so, but sometimes you're going to do that. And if the ethos is fail fast, then you've encouraged people, okay, let me find something. And if it doesn't work, that's fine. I need to know that it's not working as soon as possible, so we don't spend 6 months and a lot of money and headache and then figure that out, right? And so another example is, in the electrical contracting, in electrician businesses, period, labor is one of the biggest problems, right? There's not enough electricians. And so we're like, well, how are we going to find people? You can use temp agencies and vet the temps. You can use a headhunter, but then if you have a headhunter, then they're going to want a quarter of the person's first year salary, and you don't even know if this person's going to work out and those kind of things. It's very expensive to use a headhunter for that purpose. And so I was like, okay, we're going to try some different services. One of them, it was a couple $1,000s a month. It's called the Contractor Consultants. And so basically they handle kind of outbound recruiting for the jobs. We provide them with the job with the job descriptions and salaries and requirements and that kind of stuff, qualifications, they go and they push it out and those kind of things. And they actually do the first round of interviews. We give them the questions, what we're looking for, what we will consider, what we won't consider, and they do the first round screening. So now, and actually that has proven to be really, really effective. It's a couple $1,000s a month, but I've hired 5 guys out of it in a few months. I'm averaging 1 a month. That might not sound like a lot, but that's a lot cheaper than using a headhunter for someone that's, if I've got 5 new electricians, I can do a couple $1 million worth of work per year. That's worth a couple $1,000s a month, right? And so like that was one. I didn't know if it was going to work, and I might just be throwing $2,000 down the drain and those kind of things. But that was one where, again, it was a fail fast thing. This is whether or not we think it's going to work. We're going to give it, since it's recruiting, I can't give it 30 days. I need to give it a little bit longer. We're going to give it 90 days. And that one, we sat down and be like, yeah, okay, this is what we got out of it. Do we all agree this is working and it's worth it? Okay, great. We'll reevaluate it another quarter and see if it stopped working. But right now it looks like it is. And so, but then you get people thinking that way. What can we do differently? How can we improve this? How can I try something new without feeling like if it doesn't work, I messed up, right? Because that's a lot of times what these guys feel like is I'm not going to rock the boat. This is the way we've always done it. As long as I keep doing it, no one's going to blame me for it. But I don't think that's a very good culture, right? Now they're not empowered, and you're the one that's always pushing the cart, right? At that point, you're the one always trying to push and change things and get things to grow and get things to change. And then the burden becomes on you as opposed to them. And then whenever they do find something that works, and you can just do the ROI. Okay, that worked. They did this. This is the tangible benefit. How am I going to reward this employee? Right? So you're like, they feel empowered. They feel like they're contributing. They have ownership over their own job. They're helping the company and they're getting rewarded for it, right? So this is like the cultural change that I think a lot of these businesses need, that you can bring. Corporate America has, I think, more, it's still not great, but more than these SMBs do. This is not the way these guys think. You need to bring the mindset shift, I think, to these companies, but you do, and then they get really excited. Did you develop any incentives for other employees other than the young guy that you gave? Yeah, so other guys, we put on development track for title and for title training and responsibility increases. And we say, hey, we want you to be kind of this. We have another young guy. He's actually young. He's like 25, but he's really good. And so we put him in charge of like the apprenticeship program. So where we get guys who want to go through to be an electrical apprentice and eventually journeyman, eventually masters, is he's in charge of that entire end-to-end process. So he gets the guys, he tries to find the guys that gets it. He arranges for their classes, gets them to sign the contracts where we're paying for their training and everything else like that. He's managing, monitoring it, all that kind of stuff. At the end of this, now we're going to give him a title and a pay increase. And so he understands, here's how we're going to look at this. Our goal is in 1 year for you to be here, in 5 years for you to be here, and in 10 years you'll be here. Again, these guys are not used to someone trying to help them manage their careers and envision where they could be in 5 or 10 years. So not necessarily something like that, where it's like, I'm giving you 10% of the company or an ESOP. I'm not opposed to those things. I just haven't had time to really implement them. So I think that some of those are really good. Other guys, it's like, it's more ad hoc where, okay, this project could have gone sideways. You guys really came through. And so we're going to give an ad hoc bonus of a few $1,000s to the guys, and just rewarding them that, being like, we're paying attention to what you're doing, and your hourly rate or whatever, that's the minimum. If you exceed our expectations, we're going to reward you for it. And so then it's more ad hoc, and it also lets them know that we're paying attention to what they're doing and how they're doing it as well, as opposed to just looking at numbers on an Excel sheet. And if the numbers go up, I get more money. If the numbers go down, I don't get as much. I'm going to pay attention specifically to what you did, and how can I help you get to the next level, and therefore the company to the next level, and those kind of things. I've worked most of my career in large bureaucracies that fail slow. Where can I learn more about these new ways of doing things that energize employees? Let me look. There are some there are like a lot of guys that talk about this fail fast mentality online, and a lot of them. And so like honestly, I would just look at YouTube videos and that kind of stuff about guys talking about that. But that is a once you get that in your head that like I want to fail fast. Like another Amazonian thing is I don't want to go through any one-way doors, right? If I can help it. I don't want to make a decision that I can't undo if it's catastrophic. And so I want to fail fast, and then I want to know, okay, if it fails, what am I going to do? And so like that, those kind of cultural mindsets. So like I would say that, and anyone that's talking about fail fast or no one-way doors and those kind of things, in any of these kind of SMB space on YouTube videos or Twitter and that kind of stuff, follow them, listen to their podcast, that kind of thing. Owned and Operated is a great podcast. If you're not listening to it, it's a really good one. It's HVAC, electrical, and plumbing mainly is what they talk about, but occasionally they have landscape guys that come in and that kind of stuff. But just in general, they do a really good job about talking about systems and processes and those kind of things, and cultural things that you can bring to the table. So yeah, I would any of those, like start with the owned and operated guys. I would say in terms of podcasts, and then anyone in that orbit would be really good. Honestly, you could follow around Alan Anderson from First Internet Bank. He's on Twitter. He does a lot of podcasts and that kind of stuff. He's the guy that kind of pushed pushed my SBA loan through for this company. He's actually helping me with like a supplement to the SBA loan because we're buying a building, and so we're getting that done hopefully over the next 30 days. But he does a lot of these podcasts. Follow him on Twitter. Anyone that he's
Okay.
interacting with and that kind of stuff is really good. Just follow the people that he follows and the people that follow him, and then just build out your network kind of online. And then you're going to learn a lot of things. Like I've learned so much listening to these guys that I never would have. But really, it's just a matter of like finding who to follow and who they follow, and then just start following and listening to all the same thing. And then you'll build this kind of like, it's almost like an online library of guys, and then you can start interacting with them also online. So shoot them a question. There's another guy, his name is Bruce. He's a small business lawyer. And so like if I have a legal thing or something like that, he's an M&A lawyer, so he helps close deals and that kind of stuff. I'll go back and forth with him on Twitter all the time, like asking questions about things. What does he recommend and that kind of stuff. I might use him at some point in the future. He's really good. And so yeah, just build out your network of people. Like Acquire is really good for that too, but like it's a big world, and everyone knows each other in this kind of like acquisition space. And so yeah, that's the way I would do it.
Thank you.
Sounds like this is a non-union shop. Yes, it is. North Carolina is a right to work state. And so unions are not as big in North Carolina as it is in, if you were in upstate New York or something like that. So yes, it's a non-union shop. There are union shops in North Carolina, even though it's a right to work state. There are some benefits. I mean, I might go off on a tangent. There's some benefits to being a union shop, and there's some downsides. The benefits would be something like if we ever want to do public sector work, a lot of public sector work or military bases or something like that, if we ever want to do commercial electrical work, because just the requirements of who can have access to this facility and that kind of stuff is way more stringent on those places. And so having a union that actually has done all of that vetting and everything else like that is super helpful. Also, like just scaling up, if you need more guys, a union is going to be able to help you get more guys. They are more expensive, and you're dealing with a union. But yes, we're a non-union shop. It gives us a lot more flexibility in terms of, again, rewarding our employees and those kind of things, and seeing who has real talent that could actually help run a division, or maybe even we open up another location, they can run that. It gives us a lot more flexibility that we can take someone, plop them out of the field. Now you're the director over here and you're in charge of this. It gives us a lot more flexibility, which is why I like it. You mentioned not having the needed license for the business. Did the bank put additional requirements on the loan due to this? Was it a disadvantage when courting the seller? Did the bank put additional requirements on this? So the transition agreement included, and you can do this too. In fact, the bank's probably going to insist that you do this. You can use the seller's license post-sale for a period of time. So you'll continue to operate under their license. I had the benefit of also having this guy that I was going to make a partner that was already a part of my deal from the beginning, that already had all the licenses and bonding requirements and everything else. So I need to come up with the capital for the bonding, but he already had the licenses needed for the bonding. So we were good. But generally speaking, if the seller has the licenses, you will be able to structure so that you can continue using that for a period of time. It won't be forever. So you need to have a plan on how am I going to do it. And so the bank's going to make you write a business plan. This needs to be a part of it if it's not already. If it's not like an existing employee that you're going to make part of the long-term plan, like a partner, then it needs to be, we're going to hire and recruit this position that holds these licenses so that, once the seller transitions off, say in 18 months or something like that, I'm going to be able to use their licenses for this purpose. So yes, it would have been a problem if this guy's leaving, he's saying, no, you can't use my licenses, and no one in the company is going to be able to grant you their license. That would have been a deal killer if I can't figure that out. So you're going to have to navigate that. But generally speaking, it's pretty standard for you to be able to use the seller's licenses for some period of time. So anyway, that's the long and short of it. With that, other things to keep track of is, your employees are going to have like varying degrees of loyalty to each other. Some of them have been there for a very long time, and those kind of things. And so you need to identify not just who are the key employees in terms of who can do what, like who has the licenses, who is the like key estimator, that if I lost this guy, I'm really, really, kind of up a creek. But then also, who are the cultural like office touchstones that have influence that other guys listen to? Find those guys out, keep them happy, keep a pulse on what's going on with them. Because if you don't know that, then they can cause a lot of trouble behind the scenes, or they can be your biggest advocate. So, if there's some like, old timer that's been there forever who has a really good rapport with, a lot of the employees, his word's going to carry a lot of weight. So you might not make him a partner, you might not do anything, but keep that guy happy or get rid of him as soon as possible. You don't want someone hanging around that's a malcontent, that's influential. And so those are the kind of things that you really need to identify early. So we have one guy that is kind of a malcontent. He's not so much influential, but he's kind of a drain on other guys. And so a lot of guys just like, he's just, like I said, he's a drain. Like he's a time and energy suck. And it's just not a great culture to have around. And so we're transitioning him out of the company for that reason. And so you need to identify those guys. It's the same thing in corporate culture. If you have a teammate that's like really not, not a good fit, you need to identify that. And just because you bought the company doesn't mean there's guys there that are a good fit for the company as it is, and certainly not a good fit for where you're trying to take it as you start changing culture and that kind of stuff. So identify those guys early on and figure out a plan for how are you either going to get them to change their attitude, or you might need to get rid of those guys. And so just know, but obviously don't do it day one. Don't do it on a whim. Have a plan for it. A replacement for them, those kind of things. But you are going to have those guys or gals. But yeah, you're going to have people that you need to keep an eye on and a pulse on, and keep the pulse of the other employees on them. Last thing is like literally just FaceTime with people and do unexpected things. So like a couple, post close, like a week and a half ago, we're doing a shipyard down here in Charleston. And so I showed up, I hired a food truck for lunch and showed up with a food truck, and then just like, texted the foreman, had him text all the guys. He had like 15 guys working the site. And so then they came out and then they just had lunch and that kind of stuff. They weren't expecting it. And there was enough that I was like, well, take some for dinner too. Like, so they were all grabbing food, taking it home. It means a lot to these guys. They tend to not, they make good money, but not great money. So like little things like that, little FaceTime of like, no, this is on the company, that kind of thing, that goes a long way. corporate America, like we love our free lunches and everything else like that. But for these guys, they do not expect it. And for them, like not having to buy a $20 lunch is huge, right? It's a really big thing. So like little things like that, they're not going to break the bank of the company, but they are going to buy you a lot of credibility that like, hey, this guy cares about us. And like, there are some good things about this transition that I didn't envision. I never thought there would be a random taco truck that's going to show up to the job site or something like that. But now there is, and that would have never happened. I've worked here for 10 years. That's never happened before, right? So like find ways of surprising them to the upside, because you're going to surprise them to the downside. They're not going to like every change that you make, but surprise them to the upside too. And then at least they have something to grab onto, like cultural wise and that kind of stuff. So that's the other post-close thing. It's just constant, like, earning trust with these guys. Because what's been the hardest adjustment going from corporate tech to small business ownership? Well, the hardest adjustment is everything's on you, right? If things go bad, so, working for Microsoft, I might have been managing my own budget, but if I go over budget, I'm not worried about payroll not being made working for Microsoft or Amazon. Like these are my guys. I'm responsible for my budget. I might get yelled at about it, but I'm not worried about having to take money out of my checking account to send to someone that's working for me, working in corporate America. That is something that you might have to worry about working in your business, right? Depending on cash flow, if you're not on top of it and those kind of things. So like right now, we've got a couple $1 million coming in, but I've got $1 million coming out, and I've got to figure out, okay, based on when payroll hits and when this is going to hit and everything else like that, do I have enough cushion in it? Do I have enough cash in the bank? Do I have a big enough line of credit? Those kind of things. That's on you to figure out. And it's not going to be you getting yelled at by some corporate manager if you get it wrong and you missed it by a couple of days. It's going to be the bank calling you and be like, you went negative by $300,000. That's a very different conversation. So that's the biggest thing, is that it actually is on you, and everyone's going to hold you responsible for it. Now, there's bigger upsides too, but that's the thing. There's no one to blame but you whenever things like that happen. So that's the biggest thing, I think. It's just like the heartburn of like, okay, I need to figure this out. Like I can't put this off. I actually have to be on top of some of these things, these core things that cannot go wrong. Payroll has to be made. I have to make it. I have to figure out a way, one way or the other. And so that's the biggest thing, is that it really is on you. No one's going to help you out, right? And so that's the biggest thing, is that, with the bigger upsides when things go well, is also all of the blame when they don't. Looking back, what do you wish you would have prepared for differently before making the leap? I think preparing myself that it's going to take longer than you think it's going to. Both in terms of finding the right company, in terms of vetting the right company, and in terms of even once you find it and you're kind of in agreement, closing the deal. And then also the stress along that way. Like I had a very volatile seller who drank too much and would, late at night fly off a handle about some part of the deal that he just did not like, right? That may or may not have had anything to do with me. Maybe it was the bank adding it or his lawyers adding it or whatever. More than once threatened to walk away. He had just had too many whiskeys and that kind of stuff. And so talking him down. So like knowing that it's going to take longer, and then that's going to be like, you're going to have to find, like, just prepare yourself that there's going to be those stressful moments where you're like, is this thing that I've worked for 12, 14 months about to implode on me at the last minute? There's a good chance that that's going to happen. Now, if it does implode for reasons that aren't your fault, you probably should be, it's hard to look at it that way. You probably should be glad because you probably dodged a bullet, but you did, like, that fear of like, did I waste my time? But that's something that I wish I just mentally prepared for, that like, this is going to take longer and it's going to be more stressful getting to that close, even though we've agreed on the price and all that kind of stuff. There's still a lot of detail and a lot of stress going on there, and it was really stressful and it took a long time. So like there were like days where I was like so stressed out that I couldn't eat, right? It was actually more stressful closing the deal than actually running the company. And so like, just know that that's something that I wish that I'd mentally prepared for. And so do things like whatever it is that's life-giving to you, or whatever it is that like helps you out. Make sure that you're eating right. Make sure that you're working out. Make sure you're like, do those kind of things, because it is going to be stressful. It's worth it, if you do it right, but it is going to be stressful. And so don't neglect those other things in your life, because then you will spiral too. And if you have a spiraling sailor and a spiraling you, you need to be the stable. So were you still looking at other deals when you were under LOI? Not actively, no. At that point, I kind of put a pause on it. If something really interesting, I might take a look at it, but I wasn't actively looking at it. I didn't want to waste anyone's time. At the point that I'm under LOI, I wanted to treat it kind of like I expected the seller to treat it, that he's not looking at other buyers and everything else like that. So I was looking at it like, this is the one that I want, and this is my primary one. So I wasn't putting out multiple. I put out multiple IOIs, but only one LOI for the company that I really wanted. And then I actually quit my job at that point in corporate, because I realized that it was I wasn't going to be able to close this deal. It was going to take too long if I wasn't full time working on closing this deal. So I quit my job in corporate. So I didn't take a salary for 4 months, something like that, leading up into the close of the deal, so that I could get it over the finish line. And so I feel like it would have been the same problem if I was looking at multiple LOIs, multiple other businesses and that kind of stuff. It would have been the same thing. I feel like I would have been peanut butter spread over too many things, and it wouldn't have worked. Okay. Well, we're right at 5. Any last minute questions? Anything else? Okay. Well, if not, I mean, I'll just close with this. I had a great experience with Acquira. I truly don't think I could have done it without them, or I would have, like, my chances of making a mistake, or it taking way longer would have been exponentially higher. So like that was my experience with it. That's why I agreed to do this call. And like, Andy obviously has my contact info. If anyone, like, feel free to reach out to me, like, if you have any questions or anything else like that. But generally speaking, like the people that I worked with at Acquira, like, Hayden, Alok, Rich, those guys, all great. Really, really helpful. So really, really highly recommend. I'm glad I did it. It was money well spent, for sure.
Thank you for that, Tripp. And we really
Yeah, they're not
appreciate
paying
you
me to say that, by the way. I get nothing.
Well, anyway, thank you so much for sharing your journey and the lessons today, because we've heard valuable insights. Well, definitely balancing trust, building with negotiations, all that you've been through during your journey, which will be really helpful to, to all of the attendees today. And definitely I'll share this recording to everyone. And yeah, thank you so much for the time and for attending as well,
All right.
everyone.
Yep.
Have a great day.
Thanks, everyone.